Loews Corporation, a New York conglomerate that has been quietly compounding capital across pipelines, insurance, hotels, and packaging for 7 decades.
The Tisch family built Loews from a chain of movie theaters in the 1950s, then spent the next 40 years assembling a portfolio of durable cash flow businesses.
The operating structure resembles Berkshire Hathaway at a smaller scale. Each subsidiary runs with significant autonomy, while corporate management allocates capital and manages the balance sheet.
The largest piece today is Boardwalk Pipeline Partners, now wholly owned, operating roughly 14,000 miles of natural gas transmission and storage infrastructure across the Gulf Coast and Midwest.
Boardwalk generates approximately $1.1 billion in annual EBITDA under long-term fee-based contracts, providing the kind of regulated, commodity-independent cash flow that anchors the whole enterprise.
The second major segment is CNA Financial, the commercial property and casualty insurer in which Loews holds roughly 90%. It contributes over $2 billion of annual revenue.
CNA specializes in commercial lines, including professional liability, marine, and specialty insurance, areas where underwriting expertise matters more than just price competition.
Loews Hotels rounds out the portfolio with 26 properties in major markets, generating around $600 million in revenue and benefiting from long-term travel demand tailwinds.
Combined, total revenue reached $4.55 billion in the most recent quarter, with earnings per share of $1.78.
Loews has paid a quarterly dividend for decades, with the current annual rate at 25 cents per share. Modest in yield but consistent, a hallmark of the company's conservative capital philosophy.
The more meaningful capital return story is in buybacks. Loews has persistently repurchased shares over many years, reducing the share count and compounding per-share value for long-term holders.
Conglomerates historically trade at a discount to the sum of their parts. Loews is no exception, and that discount creates a return mechanism as persistent buybacks narrow it over time.
The competitive frame for Loews is really other capital allocators, Berkshire Hathaway and Markel, both of which blend insurance float with operating businesses and patient long-term management.
CEO Benjamin Tisch, a member of the founding family, has led since 2018. Continuity and alignment of interest are strong in a family-controlled structure of this kind.
The market cap sits near $22 billion, and the stock has returned roughly 170% over the past decade, including dividends.
13,000 employees across the subsidiaries put Loews in a scale category where it benefits from operational density without the complexity overhang that burdens larger conglomerates.
The investment case here is classic capital allocation. A disciplined management team running boring, profitable businesses and returning cash to shareholders at a consistent pace over decades.
The pipeline and insurance combination means earnings hold up in a wide variety of macro environments. Infrastructure contracts and insurance premiums are not cyclically sensitive the way consumer spending is.
That is Loews Corporation, a conglomerate with regulated pipelines, specialty insurance, hotel hospitality, and 60 years of compounding discipline behind the ticker. I'm Hudson.
And I'm Lana. Thanks for being here on Charged Alpha, the S&P 500 Stock Encyclopedia.
Loews Corporation just reported Q1 2026 earnings, EPS of $1.78, revenue of $4.56 billion. Loews is a conglomerate. The crown jewel is CNA Financial, one of the largest commercial insurers in North America. With the insurance hard market extending through 2026, CNA's underwriting profits are strong, and Loews trades at a 20% discount to its own assets. This is Charged Alpha. Let's break it down. Loews is a holding company built around 3 core businesses. Largest is CNA Financial, a commercial property and casualty insurer, 92% owned, writing roughly $13 to $14 billion in annual premiums. Second is Boardwalk Pipelines, a natural gas midstream operator, 51% owned. Third is Loews Hotels, about 25 luxury properties, 17,000 employees total. CEO James Tisch, part of the founding family, has run this with disciplined capital allocation for decades. At $22.8 billion in market cap, Loews is under the radar for most retail investors. but the Tisch family has quietly retired over 40% of shares outstanding in the last decade, compounding per-share value without fanfare. That buyback engine is the core of the investment story. Q1 2026, EPS 178, revenue 4.55 billion. No published consensus, coverage is sparse, so we read these in absolute terms. Year ago, Q1 EPS was 187, so this quarter came in modestly lower, reflecting slightly softer CNA underwriting margins and some movement in investment income at the subsidiary level. Revenue has been stable. The 5-quarter range runs from 4.4 to 4.7 billion, with Q4 2025 the seasonal high at 4.7. The balance sheet is dominated by CNA insurance assets. Total assets 85.6 billion, bonds and fixed income held as insurance float. Total debt across the consolidated entity is 8.9 billion, equity 18.7 billion. Book value per share is roughly $91. At 110.88, the stock trades at about 1.2 times book, a modest premium to book, but still a meaningful discount to what a sum of parts analysis implies. Cash flow on a trailing 12-month basis. Operating cash flow $617 million, capital expenditures $191 million, free cash flow $426 million. Those numbers are at the consolidated level. The parent company's real cash engine is the dividend stream flowing upstairs from CNA and Boardwalk. Cash at the parent is $843 million. The stated dividend is symbolic, 25 cents per year, yielding under 0.2%. Management's preferred return vehicle is the share buyback. Share count has fallen to roughly 205 million from well above 300 million a decade ago. Buyback spend runs around 800 million annually, far exceeding the 51 million dividend payout. Annual revenue grew from 17.5 billion in 2024 to 18.2 billion in 2025. Consensus expects roughly 18.5 billion in 2026. Growth is moderate. This is a mature insurance and infrastructure platform, not a high-growth business. But earnings per share have compounded faster than revenue because the share count keeps declining. That is the fundamental arithmetic underpinning the Loews thesis. Margins are stable. Net margin runs 14 to 15%, return on equity around 12%, operating margin approximately 16%. None of those numbers are spectacular, but consistency and predictability in an insurance-heavy conglomerate are precisely what the business model is designed to deliver. Wall Street coverage is sparse, roughly 6 active analysts. That reflects what kind of stock this is. Loews is not a momentum name, not a whisper stock, not an event-driven play. It is a deep value, sum-of-parts story that demands you understand insurance subsidiary accounting and conglomerate structure. Most sell-side desks do not staff for that kind of work. Among those who do cover it, consensus is buy, 4 buys, 2 holds, 0 sells. Average price target is 120, implying roughly 8% upside from 110.88. The high target is around 145. No sell ratings at all on a conglomerate that has traded at a persistent NAV discount. That tells you analysts believe the gap to intrinsic value is real and will eventually narrow. The core analytical framework is sum of parts. CNA Financial trades publicly on the NYSE. You can observe its market cap in real time. Loews owns 92% of it. Add an estimate for Boardwalk Pipelines at a market multiple for midstream infrastructure. Add Loews Hotels at a hotel chain comparable. Subtract holding company overhead and parent debt, and most models land at intrinsic value in the 125 to 145 range. Forward estimates for 2026, EPS 750, putting the stock at 14.8 times forward earnings. Revenue around 18.5 billion. Not growth numbers, but per share value creation comes from buybacks compressing the denominator, not from top-line acceleration. Structurally, Loews does not hold traditional earnings Q&A calls with sell-side analysts. The community largely uses the CNA earnings call as their proxy for Loews. Strong CNA quarter equals strong Loews quarter. That corporate opacity keeps the stock under the radar, a feature for management that wants to buy back shares cheaply, even if it frustrates investors looking for a steady information cadence. Bull case starts with CNA. Commercial insurance pricing remains in a hard market. premiums rising, terms tightening, underwriting margins improving. That cycle has run several years and shows no sign of turning. CNA's combined ratio is trending in the right direction. Boardwalk Pipelines is the second leg. Natural gas infrastructure faces structural demand. Gulf Coast LNG export terminals need feed gas, and data centers powering AI workloads are driving electricity demand that relies heavily on gas generation. Boardwalk sits directly in those corridors. Third leg, the buyback engine. Buying stock at 110 when sum of parts implies 130 plus is value accretive for remaining shareholders. The Tisch family has run this playbook consistently for 20 years. The compounding is underappreciated by the market. Bear case starts with CNA catastrophe exposure. A severe hurricane season, particularly major Gulf Coast or Southeast landfalls, could compress underwriting income for multiple quarters. CNA is predominantly commercial, not personal lines, which buffers some direct homeowners exposure, but commercial property and casualty losses are absolutely in scope and have historically been material in bad cat years. The conglomerate discount is the structural bear argument. Loews has traded below sum of parts for essentially its entire public history. There is no announced catalyst, no CNA spin-off, no Boardwalk public offering, no activist on the register. Without a catalyst, the discount can persist for years or permanently. A discount is not a self-correcting mechanism. Loews Hotels adds cyclical variance to what is otherwise a fairly stable earnings stream. 25 luxury properties, heavily dependent on business travel and group bookings. A recession or sustained corporate travel pullback would pressure hotel revenue and margins. The segment is not large enough to dominate Loews earnings, but it does elevate volatility. Finally, opacity risk. Loews provides limited guidance and minimal forward disclosure. For investors accustomed to a well-telegraphed quarterly earnings story, this will be a frustrating stock. The information gap between insiders and outside shareholders is unusually wide for a company at this market cap level. Peer comparisons use the insurance sector as the reference, since CNA drives most of Loews' earnings. Key comps: Chubb, AIG, and Travelers. Chubb, ticker CB, is the premium franchise. 16 times forward earnings, 12 times EV to EBITDA. Global platform, superior underwriting discipline. Loews at 14.8 forward PE is cheaper, but the discount partly reflects the holding company structure rather than inferior quality at CNA. AIG trades at 11.5 times forward earnings, 9 times EV to EBITDA. Cheaper on multiples, but AIG carries more execution risk, still mid-transformation, shedding non-core assets. Travelers at 13 times forward PE is the closest operational comp to CNA. Focused U.S. commercial and personal lines insurer with consistent underwriting results. Bottom line on peers, Loews is not the cheapest on headline multiples. AIG and Travelers are comparable or cheaper. The Loews argument is NAV, not multiple compression. The gap between market price and sum of parts is wider at Loews than at any pure-play insurer in the peer set. Options activity on Loews is quiet. Beta of 0.75 means it moves less than the broader market. Implied volatility is low, options volume is thin, put-call ratio around 0.9, neutral, no large directional bets. Loews does not attract speculative options flow. Insider alignment is a genuine positive. The Tisch family holds a significant direct stake. James Tisch, as CEO, and family members on the board have been consistent buyers of L shares over many years, buying alongside outside investors, not just receiving compensation grants. That alignment matters in a holding company structure where insiders have more information than the market. Institutional ownership is roughly 70 to 75%. Dominant holders are value-oriented funds and insurance specialist managers who understand the CNA book. No growth or momentum funds in the top holder list. The shareholder base matches the patient, long-duration character of the investment thesis. On capital structure, the consolidated debt-to-equity ratio looks elevated at first glance, but most of that debt sits at CNA and is matched against insurance float assets. The Loews parent carries a much lighter load. Applying industrial company debt analysis to consolidated insurance financials gives a misleading picture. Bottom line, Loews is a disciplined capital allocator at roughly 15 times forward earnings. The buyback engine retires shares below intrinsic value. The bull thesis lives with CNA's underwriting and the persistence of the commercial insurance hard market. Our read, hold with upside optionality, sound business, exemplary capital discipline. If the conglomerate discount narrows even partially, returns could be meaningful. Patience required, best suited for long-horizon investors comfortable with sparse coverage. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.